The holiday shopping season is in full swing, and its outcome will go a long way toward answering the question on every investor's mind: what is in store for the U.S. economy? This week on Money and Markets, we're checking in on the economic recovery, and we're looking ahead to 2011. Mike Larson tells us whether economic growth will speed up next year and offers his perspective on last week's disappointing employment report. Dakar examines the one factor that makes up the biggest chunk of the U.S. economy: consumer spending. And Bryan Rich explains why America's success or failure in the future may actually depend on what happens in China. Plus, Jen Amos gives us concrete investment ideas based on the economic outlook of all the Weiss Research editors. And a strategy session with two top money managers, John Browne of Euro Pacific Capital and Sebastian Leburn of Weiss Capital Management. All that and a closing comment from Martin Weiss coming up right now.
From our studios in Jupiter, Florida, Weiss Money Network presents Money and Markets. And now, Jamie Holmes.
Hello, everyone. 2011 is fast approaching, and that means investors are adjusting their portfolios for their end-of-the-year reports. A major factor in their decisions on asset allocations and stock holdings will be the health of the U.S. economy. And joining us with his assessment of the economy and his outlook for next year is Mike Larson, the editor of the Safe Money Report at Weiss Research. As always, good to see you, Mike.
Glad to be here, Jamie.
Mike, what is your overall opinion on how the economic recovery is proceeding thus far?
Well, Jamie, I'd love to say that things are great, but really all I can say is that they're less bad than they were. It's not exactly a ringing endorsement, but I think it's true. Here in the U.S., I think we are seeing an anemic recovery, but it's not being driven by what's happening here in the United States. It's really being driven by the growth in the emerging markets, especially markets like Asia and South America. What you see, again, is this dynamic where there's much stronger growth overseas and some growth, but a weak rate of growth here in the U.S. Within sectors, the retail environment does seem to be getting a little bit better. The housing market has stopped declining. We're not falling off the table anymore. But again, you're not seeing any real notable rebound. So I think looking forward and adding that all up, I'm a little more optimistic about stocks, especially those with exposure to overseas. Again, that's where the earnings and the revenue growth. But here in the U.S., even, again, we're seeing some stabilization, and that's an encouraging sign versus what we've been dealing with.
Mike, as you well know, we got some pretty bad news on the labor market last week. The U.S. economy created just 39,000 jobs last month. The unemployment rate rose to 9.8%. What was your reaction to those numbers?
Sure. It just speaks to the fact that corporate executives don't really want to hire and grow their business here in the United States. We see an improvement in sales driven by overseas activity. We see some improvement in GDP driven by things like trade. But again, when you look at the domestic economy, there's not really a strong engine of growth there. So when you're the CEO of company XYZ and you're deciding where should I build my next factory, where should I hire my next 1,000 workers, you're making those decisions and you're moving overseas. You're not doing much here. So that's why you have this case where there's a jobless recovery in the U.S. GDP is not shrinking anymore, but as you know, we're not getting a powerful jobs recovery like what we saw in the 1990s. And I think that dynamic's likely to continue.
All right, well, speaking of GDP, we found out last week that it expanded by 2.5% in the third quarter. That's a bit better than was first estimated. But what is your outlook for economic growth heading into next year?
Well, again, Jamie, I think we can continue to avoid a technical recession where you actually have GDP shrinking, but I don't expect much more than a growth rate of, say, 1% to 3% each quarter. Again, that's an improvement, but it's a very weak improvement. And when you look at what's happening in emerging markets, you're talking about GDP growth of 6, 7, 8, 9%, 3 or 4 times as strong. So I think the dynamic is going to tend to favor the countries and investments focused on countries overseas, not here in the United States.
Mike, you have talked a lot about the disconnect between sluggish economic growth and the rally that we've seen in the stock market. One of our viewers, Henry Schweinbold, he asked if you could explain the reason for that.
Sure. Again, you have to look at the response from policymakers to this weak jobs growth. What's happening? Well, you have this paralysis on the fiscal policy front. Congress doesn't want to pass another big stimulus package, and the Obama administration doesn't have the votes to force one through. So instead, you have the Fed reacting by printing money. And what you end up with there is asset inflation. It's new money chasing assets, whether it's stocks, some higher risk bonds, foreign currencies, for example, and especially gold, but it doesn't do much for the real economy. I think that dynamic, again, where you have Fed money flowing into assets, including stocks, while the real economy stagnates, is probably what we're going to be dealing with as we head into 2011.
Okay, thank you, Mike.
Thanks, Jamie.
Any discussion about the U.S. economy has to focus on consumer spending because, well, it accounts for 2/3 of economic growth. And here to tell us what she's seen from holiday sales so far and what she expects going forward is Amber Dakar. She is the supervisor of the research department at Weiss Research, as well as the author of The Busy Person's Guide to Personal Finance. Amber, so good to see you.
Good to see you too, Jamie.
What is your take so far? How's the holiday shopping season going?
Well, so far, so good. We're seeing what we've pretty much all expected to see during Black Friday weekend. Sales topping $45 billion over the 3-day weekend. Actually, Cyber Monday did even better, hitting $1 billion. It's the first time in history seeing that number. And consumers are really they're spending, but they're looking for those deep discounts and deals before they shell out those dollars.
Last week, I'm sure, as you know, we got to look at the individual numbers from retailers and how they did in November.
Yes.
Now, when they released their same-store sales figures, what did you take away from those reports?
Well, the same-store sales figures were stellar. What I could take away from that is when I look at the luxury dealers, with brand stores, which is what I really like to focus on, they did particularly well. Neiman Marcus, Saks, Nordstrom, they all averaged up about 5.3%. For Nordstrom in particular, they saw their November sales up 6.8% versus discount rack stores only seeing a jump of 2.2%. So overall, it's looking pretty good. But the key is, will this be sustained through next year?
Right, that's the big question.
Yes.
What about spending on durable goods? Orders dropped by more than 3% or so back in October, and that was following what was a very big jump in September.
Exactly.
What's been going on there?
Well, we're looking at the problem there is inventories. We had an increase in inventories over the summer, and they're still there. So it's going to take some time for that to actually clear out. And until we see that, we're going to see durable goods kind of lag behind.
What is your outlook for consumer spending going forward here, and how would you advise investors to play the retail sector?
Well, the retail sector is doing well for the fourth quarter. I'm expecting to see about 2 to 3% rise in sales this final quarter of the year. But going into next year, we have to keep in mind that consumers, they're spending, but they're using cash. They're not really using their credit cards. So until they're more comfortable in having a credit line or spending where they see fit, we're going to see some tightening going into the new year.
Okay, Amber Dakar, thank you so much.
Oh, you're very welcome, Jamie.
Another factor that we have to take into account when evaluating the strength of the U.S. economy is its standing among other countries. Joining us on Skype from St. Augustine, Florida, with a look at international trade and the global economy is Bryan Rich. He's the editor of the World Currency Trader for Weiss Research. Hey, Bryan, I like that beard.
Hey, Jamie. Thank you.
All right, Bryan, on Friday, we will get the latest reading on the U.S. trade balance. In September, the trade deficit narrowed to $44 billion. What is your takeaway from that report and your outlook for international trade going forward here?
Right. Well, narrowing of the trade deficit doesn't necessarily mean that our economy is doing well. In fact, it doesn't necessarily mean that we're exporting more. In fact, we're importing less, and it has a lot to do with the weak demand here. But in general, on a broader scale, that's exactly what we want to see this trade deficit shrink. And ultimately, we want to see trade surplus countries narrow those surpluses too and come back in balance. And that's what's going to get us on a sustainable path of growth for the global economy.
Bryan, at last month's G20 meetings, Treasury Secretary Tim Geithner was pressing for countries to have trade imbalances of 4% of GDP. That plan went nowhere. What's your take?
Right. He came into the G20 meeting wanting to send a message to other global leaders that this trade issue is big and priority number one. The ultimate goal here is for China, namely, and the U.S. To bring these massive one-way trade, this imbalance in trade, back in balance. The U.S. to stop consuming so much from China. China to stop relying so much on exports and start producing some domestic demand internally. Reality is this is the biggest issue on the international stage right now.
Okay, so realistically speaking here, Bryan, what can the U.S. do to boost exports and bring the trade deficit down further?
Well, it all really depends on China. China sort of holds the cards here. If they continue to manage their currency, to keep it relatively weaker, to create this trade advantage with the rest of the world, it becomes very difficult for other export-centric countries to compete with China as long as they're holding their currency down. And as long as they're holding their currency down, they're going to continue to exacerbate this one-way trade dynamic with the rest of the world, and it's going to continue to make their goods highly attractive here in the U.S. and drive our consumption, drive our exports rather, which will hold back our ability to create more manufacturing jobs here in the U.S., our ability to bring our unemployment rate down, and our ability to sustainably grow again.
We can't discuss international trade without hitting currencies. What is your outlook for global currencies going forward, and specifically for the dollar?
Well, there are a couple of major themes on the table right now in currencies. The sovereign debt crisis in Europe is reemerging. Ireland has already taken a rescue package from the IMF and the rest of the Eurozone. Looks like Portugal is next, probably followed by Spain. So a lot of uncertainty there, a lot of pressure on the euro. China at the same time is beginning to slow down. Thailand is in a technical recession already. Malaysia is nearing one. And then we have the tensions on the Korean Peninsula with North Korea and South Korea. All of this stuff creates uncertainty in the world. All of this stuff elevates the risk environment, and ultimately all of that bodes very well for the dollar, because people still want to own dollars as this relative safe haven in times of uncertainty. So I think going forward in 2011, we're going to see a very strong rally in the dollar.
All right. Thank you, Bryan Rich.
Okay, thank you.
Coming up next, Jen Amos will be here with more recommendations for investors based on the Weiss Research editor's economic forecasts. And later, John Browne of Euro Pacific Capital and Sebastian Leburn of Weiss Capital Management share their strategies for playing the markets in the coming year. As always, if you have any questions or comments about this week's topic, just email us at weissmoneynetwork@weissinc.com. We may not answer all of your emails or address them on air, but we're keeping everything on hand for future episodes, and we appreciate the feedback. Money and Markets will be back in just a moment.